We all know that the Federal Reserve prints money, but they don't actually print money on a printing press. There's much more to it than that. The Federal Reserve, also known as the Central Bank of the United States, is tasked to promote the health of the U.S. economy and the stability of the U.S. financial system. Thereby helps us mitigate recessions, inflation, and possibly another Great Depression. In order to accomplish such a great task, they conduct what is known as monetary policy. Monetary policy involves either increasing the supply of money or decreasing it to fix either a recession or inflation, respectively. This is done by the three tools of monetary policy: open market operations, the discount rate, and reserve requirements. For open market operations, the Federal Reserve buys and sells bonds. And when the government buys bonds back, money is given back to investors, increasing the money supply. On the other hand, as the government sells these bonds, money is being taken away from investors, thereby reducing the money supply. This also affects the federal funds rate, the interest rate at which banks borrow from one another, as a change in money supply affects interest rates. The second tool is setting the discount rate, the interest rate for banks borrowing from the Federal Reserve. An increase in this rate will make it costlier to borrow, and consequently banks will borrow less, decreasing the money supply. A decrease in the discount rate would have the opposite effect on banks, and thus increasing the money supply. The third and last tool of monetary policy is reserve requirement. This is a rule established by the government to ensure that a certain percentage of deposits into the bank are kept in reserve. The percentage not reserved is given out as loans to other customers, and these customers then again deposit the loan into another bank, allowing it to give the same percentage of money out as loans. This repeats and repeats, increasing the money supply. The formula to find out how many deposits have been created is the money multiplier. 1 over the reserve requirement times the amount of the initial deposit. An increase in the reserve requirement will decrease the multiplier, and thus the money supply will decrease, and the same is true for the converse. The Federal Reserve uses all these tools in either an expansionary manner to counter recession or a contractionary manner to counter inflation. Buying bonds, decreasing the discount rate, and decreasing reserve requirements all lead to an increase in the money supply, making them expansionary. While selling bonds, increasing the discount rate, and increasing reserve requirements will decrease the money supply, making them contractionary. The connection between money supply and the output of the economy can be explained by the money supply's effect on interest rates. By increasing the money supply, nominal interest rates fall, incentivizing people and businesses to invest into capital goods, thereby increasing overall output. This helps counteract a recession. Conversely, a decrease in the money supply increases the nominal interest rate, deterring investments in new factories, machines, and other capital goods. Thus, the overall output of the economy falls. Although things become trickier for the Federal Reserve to solve stagflation. Okay, cool. Now that we know how to cure the economy, how about
Cure my grades.